Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it's my pleasure to be your host for this episode. In today's podcast, we'll be looking at what happened over April 2025, and we'll discuss the outlook looking forward. This podcast is being recorded on Tuesday, 6th of May, 2025. And joining me again today is our Chief Investment Officer, Rob Hogg. Hi, Rob. Welcome back again. What a month. I mean, it's always unpredictable in markets, but April was crazy. Rob, if we could start by President Trump's tariffs announcements, they were again the key driver for global market movements during the month, and we spoke about this mid-month. The unpredictability of policy announcements and their subsequent changes caused incredible volatility over April, starting with the so-called Liberation Day. Just tell us what happened.
Yeah, so Steve, as you said, really it was yet another month, and I suspect it'll just be one of many months where markets just continue to be buffeted by President Trump and his announcements. So April, as we know, was completely dominated by announcements about tariffs. So that kicked off early in the month, April the 2nd, with Liberation Day. So this is when the tariffs were announced, and look, they proved to be significantly larger than investors had been expecting. And pretty much on announcement led to a very sharp downturn in equity markets and bond yields right across the globe in the very first week of the month. But about a week after that, the bond market actually started moving the other direction. Yields started rising. And in fact, it was an afternoon, really actually Australian time, although it was during the Japanese trading session, that US government bond yields rose by about 0.5%. So that was the 10-year bond and the 30-year bond, up by about 0.5% in that single trading session of several hours. So that is a signal that things are really starting to become quite unhinged. And that seems to have been what caused Trump to announce his pause on tariff implementation. From that point, equity markets gradually recovered once he announced the pause, and global bond yields retreated somewhat from their mid-month highs. And I think the really important thing about all of this is that we've spoken about guardrails around the new administration, around Trump in particular. I think we saw during the course of the month a key guardrail being the US government bond market. And when that started to show signs of incredible stress, that was really what seems to have been the key contributor to the turnaround on some of the tariff talk, indeed the pause on implementation.
Well, it's good that there are guardrails. So the 0.5 rise in bonds, that's historically a very rare event, isn't it?
Yeah, well, certainly in a couple of hours, it absolutely is.
You mentioned, Rob, that the move came in the Japanese trading session. I see that many have speculated that a large amount of the US 10-year bond selling actually came out of China and Japan. Would that imply that that's right? The reality is, I guess, that for China and Japan, it's really hard for them to find a yield as attractive as the US 10-year in the volumes that they need. So maybe the UK is a big enough market for them, but are they really going to sell their bond holdings?
Yeah, no, as you say, there's been a lot of speculation about what the cause might have been. Was it a buyer's strike? Was it instead related to some of the arbitrage-related activity that happens in the US government bond market, whereby some leverage investors buy the underlying physical bonds that match the futures contract and sell the futures contract? Look, the reading that I've done, and I really point to Citi analysts on this, they've looked at, in particular, the movement in both government and foreign private investor demand. And during the week of most turbulence, there really wasn't much sign of evidence of official sales, so government or more likely central bank sales. But what does seem to have occurred was there was a significant drop in private investor demand. So I think that is more likely to have been the cause, that foreign private investors just took the view that given the volatility with tariffs and policy more broadly, that they just wanted a higher yield to take on the risk of US assets, a higher yield and or a lower US dollar, because of course the lower US dollar has also occurred. So it's probably those two factors combined. And in a sense, it's a de-rating of US government bonds.
Yeah. So is there any data that tells you that investors can ultimately find out who the sellers were?
Well, we can certainly see what happens with official holdings in the Fed's custody holdings.
Yeah.
And look, they did decline somewhat, but that wasn't until the end of the month. So this particular meltdown, sort of halfway through the month, seems to be more driven by foreign private investors.
And so what did happen, though, was that single day move really caused the Trump administration and President Trump in particular to backtrack a bit on some of his tariffs announcements. So where are we at now with the tariff announcements?
Yeah, look, it's not entirely clear, but there are a couple of things we do know. One is that Japan's trade representative met with the US Treasury Secretary earlier this month on May the 1st with trade talks, and that the Japanese trade delegation extended their trip for an additional day through to Friday, May the 2nd. So that's something we do know. There's been talk about Chinese negotiations. They seem to have taken longer than expected to begin, but there does seem to be some sort of movement there. There's talk about potential for negotiations with India and several other countries. And look, I think this is the way it'll probably pan out, that we'll see trade deals of some shape or form occur between the US and other individual countries over the coming weeks and coming months.
Yeah. And in the meantime, I guess the equity markets will remain volatile while the announcements come out. But we'll talk about the equity markets in a little while. Just looking at the US dollar, Rob, you mentioned it was a little bit weaker. It certainly did weaken a fair bit in April. Traditionally, it has been a safe haven in time, particularly in times of volatility, but it certainly wasn't this time. I guess, firstly, just let us know your thoughts on the US dollar. But secondly, could you please comment on the view that potentially are we seeing the end of the US dollar as a safe haven?
Well, look, I think we've seen the slight repricing of US dollar assets as safe havens. And that's a product really of the higher yields across the Treasury curve, but also the lower trade weighted value of the US dollar. Look, there's no other currency that will really fill the role that the US dollar has as that global benchmark, and US assets for that matter as a global benchmark. But I think what we've seen over the last month in particular is just a slight repricing of really the risk premium that global investors are now asking for to continue to hold the US dollar and US assets. What makes this all a little bit unusual, this whole episode, generally the US dollar rallies on a trade-weighted basis during times of growth fears, but that's not happening this time. And I think it's, as we've spoken about before, it's related to the fact that it's policy uncertainty, it's US policy uncertainty that's having the impact. It's all homegrown, it's coming from the US, and this, along with the fact that an increasing proportion of the US current account deficit has been financed by foreign buying of US equities, has also made things a little bit different. So normally it's foreign investors in US government bonds that do that financing, but over the last 4 or 5 years, an increasing proportion of the current account deficit has been financed with equities, foreign purchase of US equities. So when you get a repricing of confidence and risk about US assets on the back of US policy uncertainty, and you've got the US market trading at near record highs, and you've had enormous inflows into the US market, I think all of the ingredients are there for a lower US dollar and some weakness in US equities at these sorts of times.
Right. So, I mean, you mentioned policy uncertainty, and certainly Trump added to that when he went on the attack against his own chair of the Fed, calling him a major loser. The reality is, though, that even though he has been talking about trying to get rid of the Fed chair, it's actually hard to see him getting rid of it, Powell, isn't it?
Look, it is. The Federal Reserve Act says that the President can only fire a Federal Reserve Governor for cause. But I guess with Trump, there's every possibility of some cause being found. But I think this goes back to the guardrails again. So Powell, I think it's fair to say, enjoys global investor confidence. And for him to be sacked would very likely be extremely negative for the US government bond market, and as a consequence of that, pretty negative for US equities and pretty negative for the US dollar. So I imagine it'll be a case of the guardrails. Instead, what I think is happening is that Trump's really just setting up Chair Powell as a scapegoat, really. And if the economy does weaken, as does seem most likely, and the Fed hasn't really cut or hasn't cut as much as Trump wants, I think Powell will be a very convenient scapegoat. So I don't expect these sorts of comments and this tension between the two of them to go away anytime soon. But similarly, I don't expect that we would get to the point where Trump actually sacked Powell, because I think the impact of that would be very significantly negative on US assets.
Yeah, and as you say, if he did fire Powell and put in his own person, then he would have no one to blame. So talking about the economy, it's obviously early days in terms of the administration, in terms of hard data, but certainly the comments from US corporates haven't been positive. I note we had a negative first quarter calendar year GDP figure, which was, albeit significantly affected by increased imports. Maybe start with the hard data and tell us how the US economy is going, and then perhaps if you could look at the forward-looking indicators.
Yeah. So look, certainly one of these measures, these hard data measures, is that first quarter GDP or national accounts read. But the nature of national accounts is they're really a snapshot of the middle part of the quarter. So that's effectively Feb edging into March. So really a little bit too early to be used as a guide to what's happening. But it does seem that there were some trends there that were occurring in advance and in expectation of the tariffs being announced and implemented. And by that I mean specifically, there seems to have been quite a significant bringing forward of imports into the US to try and beat the tariffs. And that is really the key reason why the overall GDP number was negative. Imports in the whole national accounts calculation are a negative. And in the case of the first quarter, actually contributed around -5 percentage points. So significantly more than the total decline of just 0.3. To be fair though, consumer spending, which contributed around 1 percentage point, that was probably boosted by pre-tariff buying. But of the two, I think the more significant is the bringing forward of imports. So that negative drag has been a little more pronounced, I think, than any positive that might have come from the bringing forward of consumer spending. So putting that all together, first quarter GDP wasn't a great guide to the actual underlying pace of the economy, but I think it was a good guide to the way importers and consumers are reacting, trying to buy and import ahead of the tariff increase. Look, since then, in the first week of May, as we usually get, we get a manufacturing survey, but we also get some hard data, that being the payroll number, the employment number. That came out Friday night for April, and that was a lot stronger than expected. In fact, right at the very top of the expected range, and that showed not only stronger employment, it also showed the unemployment rate remained unchanged. The participation rate, which is the proportion of the population either working or looking for work, that was a little bit higher again. So all of that, on the face of it, looks like a very positive outcome, but the survey date for all of these numbers was, I think, April the 12th. So again, really a little bit too early. So in sum, the hard data, it's still a little bit too early in the piece to make a judgment about how negatively the US economy is travelling. So again, we go back to the leading stuff, which tends to be survey-based data, whether it's corporate sentiment, consumer sentiment, all of these have continued to weaken. And look, I thought I might just share some of the feedback that is compiled as part of the so-called ISM manufacturing survey. So this is really, along with employment, the key data release in terms of market impact on a monthly basis. So what were corporates saying in the manufacturing sector? What were they saying in response to the questions? They were saying that things like uncertainty over tariffs is providing a big challenge from suppliers that will try to pass on tariffs to us in the form of price increases and tariff surcharges. So that speaks to margin compression. Another one saying tariffs impacting operations, delaying border crossings and duties calculations that are complex and not completely understood. Another one saying the business climate is apprehensive, and with tariff costs implemented, all inbound Chinese shipments are on hold. That was in one particular industry segment. And I could go on. Tariff whiplash. The most important topic is tariffs. Domestic producers are charging more for everything because they can. Tariff wars are incredibly volatile. So I think you sort of get the idea that the from the coalface feedback is all about the volatility, the uncertainty, the increased cost of the tariffs, and also the fact that a lot of decisions are being put on hold. Ford Motor Company has reported just recently they have withdrawn their forward-looking guidance, citing uncertainty surrounding the tariff policy. They went on to say they think input costs going forward could increase by $1.5 billion. So again, that's from obviously a very significant US corporate, the uncertainty, that so much so they're not in a position to provide any forward guidance.
No, and that's like the word uncertainty, which, has been probably the most frequently used word in the recent weeks. That $1.5 billion that Ford has noted regarding their input costs, at the end of the day, someone has to pay that. So either Ford absorbs it and their profits go down $1.5 billion, or the customer pays it, in which case inflation goes up. And this is what I just don't understand. And I'm not asking you for an answer, Rob. I just don't understand the thinking behind it with regards to how they think this can be a win, particularly over the short term for the US. So moving on to, I guess, the major target that the US has, and we've spoken about this, the major target really is China, although there's other countries as well. But how are China going? It's inevitable, I would have thought, that some corporates will look to relocate their production away from China, Vietnam, and so on. But the reality is that while the US is a huge customer for China, they have a lot of other markets, don't they?
Yeah, they do. And this is possibly one of the potential positives for the rest of the world, that Chinese goods will, as a consequence of losing some or all of their market in the US, they'll be looking for other locations, and they'll likely be asking for lower prices than would otherwise have been the case for those Chinese exports. So, I mean, you can imagine that the ongoing issues between the US and China leads to really some sort of deflationary or certainly disinflationary impulse in as far as global goods are concerned. So for Australia, that particular part of the puzzle could indeed be a positive, putting downward pressure on inflation. And that's likely going to be the case around the rest of the world as well. And I think, yes, it is inevitable that a number of companies will move their production, some parts of their production, away from China. And in fact, that had already been occurring. As you were saying, Vietnam and so on have been beneficiaries for a number of years now of corporates moving some of their or all of their production out of China.
And I noted recently, just looking at an inflation forecast for the US, obviously the US inflation forecast has increased, and this was a UBS analysis, I think. It's increased by about 0.5, 0.6%, but the world inflation for calendar year 2025 has only increased 0.1%. So that's exactly what you're saying, Rob, that yes, okay, the US as an economy will end up paying more for stuff, but the rest of the world's going to benefit.
Yeah, they well could.
And you talked about Australia. The equities in Australia really performed well over April in comparison to other countries. And really, the way I see it is it's reflecting its current status as somewhat of a safe haven. But the reality is that maybe that performance was slightly masked by the fact that several stocks, such as Commonwealth Bank, did the heavy lifting over the month. That's right, isn't it?
Yeah, I think you're absolutely right. The Aussie market performed better than almost any other market in the world, returning a little bit over 3.5% for the month. Yes, financials, particularly CBA, had a significant impact. So CBA provided, almost a third of that total return. NAB also a big positive contributor. Westpac as well, a positive contributor. Telstra also a big positive contributor here. So financials in total provided almost 2 percentage points of that 3.6% return over the course of the month. Looking to the areas which were a drag on performance, energy. The energy sector was a key drag there, and Woodside, Santos, key drags in terms of individual contributions. But yes, undoubtedly, CBA an absolute standout, providing almost a third of the market's return. I think it's worth pointing out that, yes, the Australian equity market provided one of the very best performances in local currency terms for the month, but that's against a background where the shorter end of the yield curve here rallied, so yields fell by more than almost any other country in the world. So, and I think that's one of the reasons as well, or supporting the Australian equity market, the fact that we do have, or the Reserve Bank has, the flexibility to cut rates. And indeed, that's something we'll probably see later this month. Inflation's moving in the right direction in terms of moving into the Reserve Bank's band of 2 to 3% on average over the cycle. And it seems most likely that the RBA, after cutting rates, it seems almost certain this month, as much as any of these things can be certain, they'll be able to continue doing that to some extent later in the year. So Australia, we think, is extremely well placed, in a sense, both absolutely, but absolutely in a relative sense as well, if I can put it that way. Certainly there'll be sectors and industries that'll be impacted. So agriculture with meat products, medical and pharma products, some advanced manufacturing products could be affected. And we've learned just overnight that the film industry could be affected by the tariffs that Trump has just announced. But if we look at the overall picture, Australia's goods exports to the US, excluding gold, represent only around 3% of Australia's total exports of goods and services, and represent less than 1% of Australian GDP. So the impact on us directly seems relatively minor. The impact and the risk, as we've discussed before, is very probably more related to China, given that China is our major trading partner. And in fact, that 88% of our goods exports go to our Asian trading partners, including 43% to China. So that is where the risk lies. US-China relationships. The Chinese, it seems, will really need to, in the face of this, come up with more significant stimulatory policies to try and meet and ameliorate some of the effect that is likely to occur as a consequence of the tariff battle between themselves and the US. So that, I think, is where the risk for the Aussie economy lies.
Yeah, and you're right about China. They're going to have to stimulate. But the extent of the stimulation probably, I would have thought we'll have to wait until they can work out exactly where the tariff landscape lies. And they haven't started negotiations yet, have they?
No, that doesn't seem to be the case. There's been a few words and a few positionings, but no, I don't think they've actually sat down around the table as yet.
Okay, well, moving on, you mentioned we're likely to get an interest rate cut, which is good news. So does that mean inflation's under control in Australia?
Well, it's absolutely trending in the right direction, and it seems more likely than not to continue to move in that direction, particularly, as we were saying, if we get this global disinflationary goods impact from China seeking out other markets for its goods exports. But of course, inflation here in Australia is more so driven by the services sector and by wages in particular. And look, there as well, the trends are towards, well, continued growth in wages, but at a slower and slower pace. So a sort of a disinflation in wages. So it does seem that the downward trend in inflation, so disinflation, will continue. And that does give the Reserve Bank the policy room to cut rates. And they could cut rates more than expected, perhaps, if global conditions deteriorate more than is currently expected. But they, like pretty much everybody else, are facing an enormous amount of uncertainty. So I know there's been some talk about a rate cut of greater than 0.25% at their meeting later in May. Look, I suspect they'll continue on at a pace of 25 basis points at their upcoming meetings, given that things are so incredibly uncertain.
Yeah, absolutely. One thing, and you've mentioned this a couple of times, the great thing, the only great thing really about the high level of rates that we have is the fact that it represents firepower. So they don't want to spend all their firepower in one go, one would suspect. So, but it's good news, obviously, for Australia that they're likely to cut rates. And so, Rob, let's just wrap it all up with an outlook about markets. Now, this is an impossible question, and I was listening to someone present on the US economy and the US market the other day, and their outlook was violently flat, which is an interesting way of putting it, but it just implying that, well, not implying, but stating that the volatility is going to be the key theme and that the market really is probably going to drift sideways net. But I don't know about that. I mean, one can't help feeling that with bad news yet to come out in terms of US corporate earnings, and Ford's an example, that we are likely to see weakness ahead. How do you see bonds going, interest rates and markets in the next few months? Impossible question, yes, but what are your thoughts?
Oh, look, I quite like that violently flat or?
Violently flat.
Violently flat. Look, it seems that earnings risk may well be highest in the US because of the volatility, and we had those anecdotes earlier on. But look, really importantly, the US equity market does not seem priced for a recession. So if we start to see that, for example, employment growth evaporated, or we started to see layoffs, I think we'd see an enormous change in market sentiment and the beginning of a pricing in of recession. So that type of outcome, which looks increasingly likely, is not priced in to US markets, certainly not into the US equity market. So most risk probably lies there in the sense of what's priced, not much in the way of recession, and also that a recession does seem to be more likely to occur in the US than in other countries. Because of course the Fed there has this dilemma of inflation expectations, which have risen a lot this year as a consequence of tariff fears. So they don't have as much policy freedom as, say, the ECB would have in Europe, or so the Bank of England would have, or certainly the Reserve Bank would have. So less potential firepower to reply. So the risk, I think, lies there, not priced for recession, so still potential downside risk. Here in Australia, as we were saying, look, yes, market metrics are still pointing to valuations at pretty high levels historically, so there's risk there. But there's more policy freedom here to do something about the economy if things do start to slow down dramatically. So that's significant as well. On bonds, the US could well trade a bit differently to the rest of the world. The US is facing an enormous budget deficit, which seems unlikely to go away anytime soon, particularly if the administration starts enacting tax cuts. So that will be a heavy weight, I think, on the bond market, and may well limit the extent to which bonds might rally or yields fall if the US were to slow significantly. Here in Australia, I think there's a bit more room for bonds to rally, so yields to fall if the economy weakens. So we could well see that in a scenario of weaker growth and lower inflation here in Australia, that the bond market here could outperform what we might see in the US, notwithstanding the fact that really global bond markets are trade very tightly relative to each other. The outlook for the currency, and whilst currency outlooks are extremely difficult to make any judgment about, on measures I've seen the US dollar does seem to be pretty fully valued. That together with the fact that a lot of the funding of the current account deficit's been into equities, US equities, and it seems investors now want a higher margin of safety, if you like, so a higher risk premium. The path for the US dollar still looks a bit heavy, I think, from here.
Right. And so just to summarise that, Rob, what you're saying, the way I see it, is that volatility is going to remain. That's a given. But we're unlikely to get a bear market in the US, 20%, 25% retraction from peak, unless the US economy enters a recession. But if it does, the market's not priced for it, right? So
that's right.
Yeah. So there is a chance, certainly, that we'll retest the lows we saw in April, isn't there?
Look, yeah, I think absolutely. So look, the market has clearly stepped down from its highs around Feb, but it wasted no time in rallying from its lows earlier in April once the talk about tariff delays took place. So yes, I think you're right. Some earnings downside has only really just begun to be priced for the US. So there is absolutely the possibility the market could retest its lows if we start to see numbers that point to a higher probability of recession in the US. Not in the hard data yet, but it's absolutely in all of the leading indicators, the sentiment surveys, etc., etc. So if the uncertainty continues and we continue to see companies put off spending decisions, hiring decisions, and we see households do exactly the same, a recession looks more and more likely. So a retesting of lows remains a very real possibility.
The silver lining of that, Rob, is that there aren't many times where good quality companies, growing companies, offer reasonable pricing. So for us as active managers, it is an opportunity over the next few months to pick up those stocks that are normally too expensive, that we believe are very high quality. It'll be interesting, and obviously the volatility is going to continue and there will be opportunities. So Rob, thanks very much for your time.
Pleasure, Steve, as always. Thank you.
And that brings us to the end of today's podcast. We looked at what happened in April, and it was an incredible month, one of the most volatile months for a long time. We then looked at what it means for investors going forward, with the reality being that unpredictability and volatility is going to stay around for some time, as we've discussed. We hope you enjoyed today's episode. Please subscribe so you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcasts from. And please do let us know if you have any questions or comments. Until next time, stay informed and stay active. This podcast is produced by SG Hiscock and Company. It does not constitute financial advice and assumes a certain level of knowledge. It is general information only and does not take into account the investment objectives, financial situation, or needs of any person, and should not be considered a recommendation.